Hey everyone, today we are sitting down with Parker Pinkalla, the co-founder of Tailwind Investment Group. Parker and his partner Peter founded the company just a year ago, actually 10 months ago.
Yeah, correct.
And you guys focus on value-add apartment investing on the West Coast, right?
Correct. Yeah, southwestern U.S.
Well, thanks for being here, Parker. I appreciate
Sure.
it. If you can, give us a little background on who you are before we dive in on Tailwind. Give us some backstory on who you are and kind of how you got started in the biz.
Sure. Well, I'm originally from Texas. I ended up in California about 16, 17 years ago from college and never went back to Texas. And out of college, I took a job with an investment fund manager called Fowler Property Acquisitions. And I was there for about 14 years and kind of made my way from San Francisco to LA and now obviously in Newport Beach down the street from you. And I founded Tailwind a little less than a year ago, and that's my new focus, aside from my family, of course.
Yeah, of course.
Yeah.
So when you first got started in the business, you went to go work at Fowler. Tell us about that. Like, what areas did you cover? How'd you get started in the business?
Sure. I started as an analyst right out of college at 22. So really kind of supported an acquisition team. And then, got the opportunity. Oh, shoot, now that I think about it. I started in '07 when it was popping.
Yeah.
And then kind of, worked my way through the recession somehow, some way, and got the opportunity to basically cover the southwestern U.S. for the company and do acquisitions. And I did kind of that role for about 10 years, and we're actively investing in, Phoenix and in all of California and Salt Lake City and very, very active in Vegas. So a lot of kind of the high growth markets that have been sort of, where there's more population growth, more employment growth, low supply markets. So really kind of just focused on that. Yeah.
And then your role was learning those markets, learning the brokerage community,
Yeah.
finding deals.
Yeah. It was the way that company's set up in an acquisition capacity. Really, you're really just focused on managing broker relationships, sourcing deals, managing the contract process. But we were a really high volume shop. In some years we would close 40 or 50, deals.
Wow.
In the calendar year. So every acquisition guy, we were kind of spread out regionally. But it was a very much kind of eat what you kill type company, and everybody was hard charging. I mean, the principal, Greg Fowler, he's kind of an industry savant, one of the hardest working guys in the business. I was certainly real lucky to sort of learn from him. I'm certainly very grateful for the opportunity too. But yeah, it was wild. I mean, we just, we did a lot of deals and it was fun.
So with the amount of deals you were doing, you just kind of leveled up really quickly and just more activity, you got more experience.
Yeah, I mean, I think the key, just in sourcing opportunities, and we were doing so many deals, like we just, because we were doing so much volume, we had to really focus on trying to find a lot of stuff with more of a shotgun approach, or trying to find off-market deals or direct to seller. So a lot of what we focused on was just, creating strong relationships and trust in the community, and ended up working out. But yeah, it's just great experience for sure.
And then what was kind of like the deal size? Was there like a kind of a number where you guys were like, look, I'm buying, I don't want to go too small. Where was it like the sweet spot for like economies of scale?
I mean, it changed, when in 2010, Greg raised our first value add fund. It was like 300 million of equity. So we had $1 billion of buying power in that fund. And then fast forward to, about a year ago when I left, and they had $2 billion funds, which had $5 billion of buying power. So, 10 years ago, a $15 million deal was like a normal size deal coming out of the recession. And now that deal might be worth 70 to 100 million.
Yeah.
So it's kind of changed. And I think what was unique about FPA comparatively to some other larger institutional fund managers is they were willing to do smaller deals. So we would do a $10 million deal if it was a good deal. We would do a $400 million deal if it was a good deal. There was no sort of sticking your nose up because of the size. I mean, Greg was focused on finding good deals, whatever size it was insignificant. I mean, we had national management and construction management in-house, and it was a big company, so he just felt that we could kind of manage even the smaller stuff. So kind of set us apart, and that's how we were able to do some additional volume, just because we would do some smaller deals. Yeah.
So you were at Fowler, and then how many years were you at Fowler?
I was there for 14 years.
14 years. And then in 2021, you
Yeah.
started Tailwind.
Yep.
Where did that decision making, when did it come and hit you saying, you know what, I want to start my own?
I think for me, it was just sort of a natural progression. Once you do anything for a long period of time, and you're ambitious and, you sort of dream of maybe starting your own company, and it's scary and stuff like that. But for me, it just kind of felt like, what I wanted to do, for this next kind of period in my life where I'm setting up my family, this stuff.
Mm-hmm. Yep.
But, try to build a company so hopefully, you have something for your kids, after the next 30 years. And just for me, it felt like the right time. I met the right partner for myself, which was a really important piece.
How did that, tell us about that. Tell us about your partner, Peter.
Yeah, sure. Well, I met him through, a really close friend of mine, his brother-in-law, actually, who coincidentally was my roommate in Newport Heights here, in our mid-20s, right out of college. So a lot different sort of experience than, fast forward 15 years later or whatever it is. But I met him through his brother-in-law, and he actually because he was at KeyBank, he financed a deal for me.
Oh, okay.
So I had sort of a more an easier way to get to know him through sort of working on a deal together, and he expressed some interest in being on the principal side, and just it's funny how stuff, right place, right time.
Right.
We got along real well. It was kind of that simple.
And then
I pitched him the idea.
You pitched him the idea.
Yeah. I pitched him the idea, and it's scary to leave, your comfort zone and a place you've been at for a long time, and that's the hardest part, really. Just pulling the plug, of what and getting uncomfortable. I think that's the hardest part.
So Tailwind was kind of born in formed and kind of put together in COVID.
Yeah.
Kind of an uncertain time there.
Yeah.
But you knew the opportunities, you were ready for it, you had your partner, and then just 10 months ago you guys formed in 21, right?
Yeah. I mean, COVID naturally you have more time to think, right?
Yeah, for sure.
So, I mean, I guess, in some ways, I guess now that I think about it, maybe COVID did have a positive impact in some way on me, that I had more time to think and look around. And, I think a lot of people, you tend to, especially in a fast-paced career, you're moving quickly, right?
Mm.
COVID forced us to all sit down and think about ourselves and our,
reevaluate.
Yeah, totally. I mean, that's now that I think about it, in hindsight, I feel like that's what happened. So.
That's great. And then, so what does Peter, you guys kind of divide and conquer on certain roles? What does he do? What do you do?
Yeah. I mean, I think when you start a company, it's kind of all hands on board, right? I think generally, I'm kind of focused on setting the strategy and focused on kind of running our acquisition business. And, generally he's kind of running more of our capital markets. So, running the financing, for a while there until we made a more recent hire, we were both asset managing together. He basically runs our operating company, from managing our attorneys, and there's just a lot of stuff that, you don't think about that has to be done. Managing our third-party property management companies. It's kind of a divide and conquer thing.
Mm-hmm.
It's kind of funny because like in a growth trajectory, it's kind of like the chicken and the egg. Like at first, like you're having to grow this company so that you can hire people to backfill
Yeah.
specific roles within the company, like execution, for instance. Like you kind of have, like when you start early, unless you have a great amount of liquidity, um, you kind of have to buy the deals, buy 6 or 7 deals, so you have enough fee income to pay a quality asset manager, a quality construction management person, bring on the right accountants. So it's sort of unique that you kind of just figure it out at the beginning and backfill once you're at capacity. I mean, that's kind of what I've seen, a lot of guys that have done this. It's the most efficient way to do it, which, that just means that everybody's doing a lot of the same stuff. Yeah, I mean, that's kind of, and for him and I, it's like there's no ego, and we communicate well, and it's like we just get stuff done.
That's great.
Yeah.
You guys complement each other.
Yeah, I think so.
So what was one of the first hires that you backfilled once you kind of got a little bit to scale?
Well, we started, we brought in like an analyst associate for, analytical support. So he was hired, before we opened our office on April 1st. Like he was ready to go. So that was an important piece. We could not have started without him. And then, we brought on, a controller next, kind of getting our organization in order and all of our accounting stuff, which becomes very important if you're bringing in institutional investors or any investors really.
Yeah.
And the kind of the most recent hire was, with a guy that's sort of helps us on the execution. Now that we have all these deals, we have these great partners that trust in us. Like, okay, yeah, you actually have to execute on your business plan.
Yes.
Yes, we do. So we brought in, a guy that was at another large company, was really well experienced. That was the thing with the big hire. It's like, because we're doing a lot, we wanted to bring in somebody that could like complement us, hit the ground running, versus like having to bring in somebody to train.
Oh yeah, that'd be.
When you're focused on production and trying to grow the company the right way, it's just bringing in a guy, even if you have to pay a little bit more or whatever, like bring in the right guy that can actually do the job versus having to train somebody for 6 months to a year, which, maybe that's not a good use of your time.
True.
Running the company.
True. So
that's kind of the way we approached it.
Makes sense.
Yeah.
So tell us about the first deal you bought under the Tailwind.
I actually had a personal relationship with the guy. I had known the guy for 10 years. He's owned a deal in Phoenix, and I was in Park City at a ski trip that I go to every year with a number of different sort of real estate guys. And I mean, it's funny because my wife's like, "You're going skiing every year with all your buddies. What are you guys doing?" And she like kind of gives me a hard time, and I'm like, actually, that was actually where my first deal was cut.
See,
was
there you
on
go.
The ski trip.
Yeah.
Just so you know.
Yeah.
It's not a boondoggle. So yeah, I mean, I think it's a relationship business, and a guy that I had known that FPA, we'd actually sold him some deals in the past, and I had maintained a good relationship with him on a personal level, and he said, "Hey, I'll sell you this deal. This is the price. You have to pay the price." And
how many units?
It's 108 units in Phoenix. Yeah, that was our first deal. Yeah.
In what, April, May? 21.
So I think we tied it up. In middle to end of March, and then I think we closed on June 26th. Yeah, those are.
So it was
you remember your first kiss, right?
Yeah, that's right.
June 26th.
First deal, first kiss. So it was you, Peter, and then your analyst.
Yes, correct.
That kind of took down the deal and then started executing the business plan.
Correct. Yeah. I mean, at that point we only had one deal, so it's like 3 guys is enough to asset manage one project. Right?
Makes sense.
That's what we figured.
Yeah. And then did you third-party management?
We've chosen to kind of use regional property management companies at this point. We just feel like with the groups that manage in specific markets, 15 to 30,000 units. For us as a smaller company that's growing, like we get more attention than we would if, we used like a larger, like a Gray Star, for instance. Like,
Yeah.
we want to work with the people that we can pick up the phone and like, get a pulse on the other end and like fix problems and like easy to communicate with, because, we're really focused on, on a weekly basis.
You need that.
Making sure that our properties are operating properly.
So do you have a weekly call and there's action items and you're
Yeah.
just kind of working through it?
Exactly. Yeah.
No.
So there's biweekly calls and you nailed it.
Manage the manager.
Yes. Yeah. And it's 30-minute call, whatever. But just that's the key, though. You have to have good property manager, and you have to, they're only as good as like. That's the thing I think that I've learned is like, you can't just like hire the property manager and like put the property on cruise control if you want it to operate at the optimal level. Like, you actually have to come up with the business plan
Mm-hmm.
and tell them what to do. That, at least that's my experience,
that makes
for
sense.
sort of best success. So that's why we're talking to these people all the time. I know for a lot of more passive managers, they don't passive owners. Sorry, they may not want to do that, but we're really focused on trying to create value for investors, and I think that's the best way to do it.
Got it. Makes sense. So that was your first deal, your first kiss.
Yep.
What transpired after that first deal? You tell us about the markets you're buying in, and then kind of how many buildings you bought since then.
So I think generally, like, we're focused on Texas and West. I mean, we're not covering every single market, but if you start in Texas, like, we like Houston, Austin, Dallas, San Antonio. We like Denver, we like Colorado Springs, we like Albuquerque, we like Phoenix, Tucson, we like Reno, Vegas, and then most of Southern California, and Sacramento, Portland, Seattle, Boise. I mean, hypothetically, like, there's a lot of markets that we like. The reality is that, just myself is focused on acquisitions on a daily basis. Just a lot of markets to cover. But I think that when I kind of formed the idea to start the company was to focus on markets with low rent income ratios, because we felt like that's where there was kind of the most runway for growth. So when COVID hit and you saw a lot of markets sort of go in the opposite direction, like the New Yorks, the San Franciscos, the LA, those are the markets where people are paying 40 to 50% of their monthly income towards rent, right? So there was a natural correction, right?
Yeah.
The markets that were most resilient during COVID, when there was, weird times in the market, were the ones where people are paying 20% of their monthly income towards rent. If there's population growth and good jobs are added in a lot of these sort of secondary markets, you feel like, okay, well, there's better potential for growth if somebody goes from 20 to 25% of their monthly income towards rent than 40 to 45, right? Hypothetically.
Totally. Affordability.
So that's really, when we kind of set out the strategy, it was really focused on markets, and we pull the data and we know, Tucson's, people on average pay 18% of their money. Maybe a year ago they did. It might be more now, right?
Yeah.
But we pulled the data, and that's how we came up with our plan. It's information-based decision making.
And some of those markets of brand, like you're mentioning. So where, all else equal, if you could buy a deal anywhere, where are some of the, you mentioned a lot of different markets, but is there any particular ones that you're really bullish about?
I would say generally it's the low supply markets. So where there's, less new construction. One of the reasons why we've been super bullish and active in the Inland Empire is because there's a really limited development pipeline. And obviously, with all the industrial logistics jobs, there's a ton of job growth. So really focusing on sort of supply constrained markets. Albuquerque's another good example of that. But generally, we track all the employment growth, and we track all the population growth. We really like Vegas a lot for that reason. There's a ton of people leaving California. Obviously, that's well publicized. That's 4 hours away from here, and obviously a lot lower cost of living.
Right.
They're attracting better jobs now, and they're really don't have a large development pipeline comparatively, like if you compare it to like a Phoenix or downtown Salt Lake or whatever. So, I mean, that's kind of stuff we look for.
Have you bought in Vegas yet?
Ask me next week.
All right.
We're looking. I mean, we lost out on a couple deals, and funny enough, my partner is there today, kind of focused on an opportunity that we're trying. We want to be there. It's not for lack of effort.
Yeah.
It's a competitive space.
I believe it. It's competitive everywhere, it seems.
Yeah.
So you bought in Inland Empire, Salt Lake,
Yep.
and Phoenix so
Yeah,
far?
two deals in Phoenix, 2 in Salt Lake, 2 in the Inland Empire, and then there's another project that we have under contract that's not closed. It's also in Southern California.
Oh, that's great.
Yeah.
So how many units does that put you under right now?
That's 1,200 units.
Okay, good.
Yeah, since June.
That's great. That's
So
amazing.
our first closing
I mean,
was in June. Yeah.
that's how many months ago? 8 months ago?
Yeah.
Something like that?
Yeah.
That's amazing. So
Appreciate it.
what do you think is going to happen in 2022? Do you feel it? I mean, we're wrapping up the first month of the year. It just feels like the market's tight.
Yeah.
There's a lot of capital buying up deals in California, and the money's migrating out of California.
Yeah.
Do you anticipate, what do you see? It's probably going to be tight all year?
I think the reality is, if you look at what the Fed says, is they're going to raise rates.
Yeah, that's true.
3 or 4 times, and and I think that's already being priced into the market. But it feels like rates are potentially going to go up. But if you look at all the sort of the rent growth data, I mean, last year was sort of a crazy year in which markets had sometimes 20 or 30% rent growth depending upon the market.
Amazing.
But like comparatively, like I think if you look back like the last 10 or 15 years, like if you get like 4 or 5% rent growth in a year, you're pumped, right?
Yeah.
And like in most of the high growth markets this year, like you're getting like 5 to 7% rent growth. This is still a great rent growth year.
Yeah.
It's just going to be less than it was last year. But I think on a go forward basis, a lot of the markets, if we're looking on like a 5-year horizon, I mean, rent growth's going to slow down eventually.
Yeah.
And, rates are going to be potentially moving up. So we're cognizant of those things. I mean, it's not being priced in today. I mean, market's as aggressive as ever. There's, just like you said, there's so much capital chasing, a few amount of opportunities. I don't know what impact that has, but hypothetically, if you look back, that's what should happen is, maybe there's, some sort of price adjustment in cap rates if rates end up moving up. I don't know.
Yeah, maybe. I mean, it feels like today that if rates move up, the rent growth might just offset that. It might just be a wash. Potentially, we'll see what happens, but it just seems like it might just be tight. There might not be a whole lot of change.
No, people are just going to keep buying low caps.
It's just
it probably is going to be the case, right?
3 cap deals.
I mean, the option is like where else, if you can get a 5-6% coupon, like
Tangible real estate. I mean,
you're competing with sort of other alternative investments. It's like, okay, that sounds pretty good.
Yeah.
And you get the depreciation and whatever else.
So a lot of people watching it that are on the channel are Southern California investors. They like getting updates on Southern California. Some of them have moved their equity out of Southern California and bought in Texas or Arizona or Florida. It feels that the cap rates have compressed so much out of state that are they getting about where the cap rates
Oh yeah,
stay or about where they
every
are?
market's
Everything's kind of just
everything's at
turned
3.
into California pricing. Almost.
Everything's at 3.5.
Yeah.
Everywhere. I mean, like 10 years ago, like there, Tucson to San Diego, like there was a 250 bip spread in cap rates. Today, it's nothing. You're still paying at 3.5 in Tucson or San Diego. It's the same.
So if you can find enough, with affordability to work here with like kind of your rent income ratios that work, would you, all else equal, would you just double down in California if you could? If you can get those.
We like California for different reasons than we like some of these sort of secondary high growth markets. I mean, the reason we like California is because it's such a pain to build here. It's challenging, it's costly,
Right.
It takes a lot of time. So it's really supply driven investing. And a lot of the other markets that we're investing in that are secondary type markets, investing for because people are moving there and employers are moving there. It's really more growth, geared investing, and really here in California, it's just, supply driven.
Yep. And then as far as we've seen some investors here locally that have sold and gone, usually it's you sell apartment real estate, you get into something passive, you go buy a single tenant net lease deal and you kind of clip the coupon. But there's been more investors that have sold multifamily here and then exchanged out of state into multifamily. That was a bigger trend for your kind of mom and pop high net worth investors to do that. Some have exchanged and gone into a tick deal and rolled up as an equity investor for a bigger group.
We've had a couple of those.
Do you do that?
Yeah, we have. It's funny, that actually the first Phoenix deal that we did was a 3-tick deal, which I had no idea how to structure until March of last year. But luckily, I wasn't the guy that invented it. And there's several sort of really, great track record investors that own a lot that kind of cut their teeth on, these types of structures. But, for us, it was, meaningful to be able to, we really wanted to have this sort of two-pronged business where yes, we have our institutional or quasi-institutional investors that we manage capital for, but we also want to have a syndication business because it gives us the opportunity to potentially trade out of those deals,
right?
And create wealth with not having to pay taxes for the investors. And I mean, to us, that's a really efficient way to create value. And so we kind of want to have two different businesses.
That makes sense.
Yeah,
I like the tick deal because if I had a portfolio at some point, if it just depends on succession or what you end up doing with it, it's hard to give it a management company and just hope they run it well. But you can do an exchange. You can exchange and instead of becoming active, you move passive, but you're still getting all the benefits.
I mean, a lot of these guys have made their money. They don't, it depends on how hands-on they want to be. But for us, we have infrastructure, we're close to the market. Depending upon what these people's objectives are, it's a good fit to work with somebody like us where, we're going to be around for the next 30 years doing the same thing. And, maybe they want to spend more time with their family or play more golf. I don't know, but if they do, then we're good.
That could be
we're a good match. Yeah.
It seems to make sense. Seems to be that's where a trend's kind of growing. Before, I don't think that was as common, maybe 5 or 10 years ago. But
yeah, it seems I'm seeing more of that.
Yeah. So that makes sense. So what's your plans for 2022 other than buying more deals? I mean, that's the name of the game? Just scale?
What do you mean,
double down more?
Well, I'm doubling down. The twins are coming.
Yeah, that's right. You are doubling down in multiple ways.
I'm doubling down.
Congratulations!
Thank you. Appreciate it.
That's awesome.
I had to give them a little shout out real quick.
Yeah, of course. When's the due date?
July 30th. If I butchered that, my wife would have crushed me. July 30th. It's my mom's birthday, so I remember it's July 30th. As far as our plans this year, I mean, going to continue kind of doing a lot of the same as we had last year in terms of, our strategy investing in a lot of these high growth markets. I mean, we also kicked around the idea of trying to do some more, urban infill investing in markets that, have been flat or negative rent growth where, everybody's chasing the suburban, affordable markets right now and just slugging it out. It's probably the most competitive space in the asset class.
Mm-hmm.
So, we've kicked around just a couple other ideas of maybe places that, we could potentially capitalize on, a more organic market recovery. It's such a herd mentality business and things change a lot and trends change. And, I think one of the sort of, it's not a challenge, but, one thing I'm constantly trying to figure out is okay, how can we be creative and trying to figure out what's the next thing that's going to happen? And no one has a crystal ball, right? But just trying to think forward and trying to have an opinion on, a strategy before everybody goes back in.
Yeah, that's true.
So
we were talking before, we got to sit down. I mean, it's just everybody's going non-contingent day one on deal.
Oh, yeah.
It's just
rite of passage.
It's super competitive and, unbelievable. So,
yeah.
Well, thanks for joining us. Thanks for sitting down on the couch.
Appreciate it.
Sharing your story.
Sure.
Where can people find you? Where you got your website?
I'm very easily accessible.
Yeah.
Yeah, I think our Our website is tailwind-ig.com. We have an office right here in Newport, but you could always ask you for my number.
That's
Dan,
right.
too.
We'll put it in the link below. Just if somebody wants to reach out,
Anytime.
connect.
Happy to talk to
appreciate it.
anybody. Yeah,
We'd love to have you back on when you 2x
that'd be great.
on family and in units.
I appreciate that.
Over the next few months here. So
Sure.
thanks for being here.
Thank you.
All right, we appreciate it.